Japan didn't send a warning. They didn't ease into it. They hit the global economy like a sledgehammer. And in a single move, they shook the foundation of every major bond market on Earth. If you don't understand what just happened, or why the US is suddenly feeling the pressure, stay with me, because once you see the pattern, you'll understand exactly why this moment could redefine the next decade of money, power, and global stability. Before we go deeper, pause for 1 second. If you want to stay ahead of global shifts like this, not react when it's too late, make sure you're following, subscribed, and tuned in. Every week, we break these events down so you have clarity, not fear. Now let's continue. Japan's policy shift sent a shockwave through global bond markets because for decades, Japan has been the quiet anchor of the world's financial system. Their extremely low interest rates created an environment where investors could borrow yen cheaply and pour that money into higher, yielding assets around the world. This wasn't a small side strategy. It was one of the biggest invisible forces powering global liquidity. The moment Japan changed direction, even slightly, that entire structure wobbled. When Japanese bond yields suddenly moved higher, it instantly made holding Japanese assets more attractive than before. Investors who had been comfortable keeping money abroad began pulling funds back home, causing large, rapid shifts in global capital flows. This was not a gentle rotation, it was a snapback. And global markets felt that snap immediately. Bond prices in multiple countries dropped, yields spiked, and the stability many investors took for granted evaporated almost overnight. Japan's policy shift also signaled a deeper psychological change. For years, people believed Japan would never alter its ultra-easy stance because its economy was too fragile and its deflation history too persistent. When they finally made the move, it shattered that assumption. Markets don't just react to numbers. They react to beliefs being proven wrong. That's why the reaction was so violent. Investors weren't just adjusting positions, they were rewriting their mental models of how safe, predictable, and stable the global financial environment really is. Every trader who had built strategies on the assumption of endless cheap yen suddenly found themselves exposed. That exposure created forced selling across multiple asset classes, adding pressure to U.S. markets and emerging economies at the same time. Japan's decision became the trigger that reminded the world how interconnected everything is. A policy move in Tokyo could destabilize assets in New York, London, Shanghai, and beyond, because the system had become dependent on one country's financial generosity. When that generosity tightened, the world felt it. The yen's reversal marked a turning point because it ended a long era where Japan's currency was intentionally kept weak, making it cheap to borrow and profitable to send money overseas. For decades, that weak yen acted like an engine that pushed Japanese investors and global hedge funds into foreign markets, especially U.S. stocks, bonds, and real estate. It also created one of the largest financial strategies on the planet, the yen carry trade. Investors borrowed yen at almost no cost, converted it to dollars, and chased higher returns elsewhere. As long as the yen stayed weak, that trade was safe, predictable, and unbelievably profitable. But the moment the yen strengthened, everything flipped. Borrowed yen suddenly became more expensive to repay, profits shrank, and positions that once looked secure turned risky. This reversal sent a message that the era of easy, near-zero Japanese money was ending. This was not just a currency move, it was a psychological shock. Investors realized that the reliable foundation they depended on was shifting. A stronger yen meant that Japanese institutions, pension funds, insurers, banks, would no longer feel the same pressure to chase higher yields abroad. They could earn more at home simply by holding Japanese assets. That change created a natural pullback from U.S. and European markets. Money that had flowed outward for decades began trickling back into Japan. Even a small shift in that flow has massive consequences because the Japanese are some of the largest foreign holders of U.S. assets. When the currency strengthens, the incentive to unwind foreign positions grows, and the unwinding process impacts everything from Treasury yields to stock valuations. Beyond that, the reversal signaled that Japan was no longer willing to export deflation and excess liquidity to the rest of the world. The country was entering a new phase, one where it needed a stronger currency to combat imported inflation and rebalance its own economy. This internal shift had global consequences, reminding investors that the stability they assumed from Japanese policy was never permanent. The yen's move wasn't just an economic adjustment. It was a sign that the global financial system was drifting toward a new alignment, one in which Japan's role would no longer be to supply endless cheap capital to the rest of the world. The pressure on U.S. assets showed up almost immediately because Japan's reversal hit the global financial system at one of its most sensitive points: liquidity. For decades, Japanese institutions were steady buyers of U.S. treasuries, corporate bonds, and even equities because borrowing yen was cheap and investing abroad offered higher returns. When the yen began strengthening and Japanese yields rose, that incentive weakened fast. Investors who once relied on the spread between low Japanese rates and higher U.S. returns suddenly saw that gap shrinking. The natural response was to pull money back home or reduce exposure to foreign assets that now carried more currency risk than reward. Even small shifts in these flows create ripple effects, because the U.S. depends heavily on foreign buyers to support its massive bond market. The moment demand softens, yields rise, and rising yields immediately pressure everything tied to borrowing costs, from mortgages to corporate financing. This shift also created discomfort because U.S. markets were already stretched. Stocks were priced for perfection, bond yields were near multi-year highs, and investor sentiment was fragile. When Japan changed direction, it didn't just move numbers, it moved confidence. Traders saw the yen strengthening and Japanese funds rotating inward, and the selling pressure in U.S. assets increased. Part of this was mechanical, triggered by algorithms reacting to currency volatility. But another part was psychological. Markets hate when long-standing assumptions break, and one of those assumptions was that Japan would always provide steady demand for U.S. financial instruments. When that assumption cracked, investors reassessed risk across the board. At the same time, higher Japanese yields competed directly with U.S. yields for global capital. For the first time in decades, investors could earn more in Japan without the currency risk they used to face. That meant less automatic preference for the U.S. dollar and for dollar-denominated assets. As capital rebalanced, U.S. bonds weakened, funding costs rose, and equity markets felt the strain. This wasn't a collapse, it was a recalibration. But recalibrations can be painful when markets are positioned on the edge. Japan's shift revealed how much the U.S. relied on foreign liquidity and how vulnerable asset prices became when even a single major source of that liquidity started to retreat. Bond yields spiked worldwide because Japan's move acted like a signal flare that told every investor, every bank, and every central bank that the era of cheap global money was ending. When Japan allowed its bond yields to rise, it didn't just shift its own market, it changed the reference point for global risk. Investors compare yields constantly. If a traditionally low-yield country like Japan suddenly offers higher returns, the relative value of other bonds across the world must adjust. That adjustment happens through rising yields and falling prices. The selling begins with traders who rebalance their portfolios to take advantage of the new Japanese returns. And then it spreads as algorithms detect the yield gap tightening. Soon, bonds from the U.S. to Europe to emerging markets experience pressure because the global system is interconnected through expectations, not just numbers. A spike in yields is also a reflection of fear and uncertainty. Japan's decision forced investors to confront the possibility that other central banks might follow suit, or that the underlying foundation supporting asset prices had weakened. Higher Japanese yields often imply a stronger yen, and a stronger yen signals a reversal of the carry trade. a major engine of global liquidity. When that engine slows or reverses, investors start reducing risk. Across all markets, bond markets tend to react first because they are the deepest and most sensitive to shifts in capital flows. Once selling starts, yields jump quickly, even in places where fundamentals haven't changed, because global markets move as a single organism when confronted with a major shock. The spike was intensified by the fact that markets were already fragile. Governments around the world had issued massive amounts of debt at low rates, assuming those low rates would persist. When Japan disrupted that assumption, it forced investors to reconsider the sustainability of those debts. Higher yields mean higher borrowing costs, and higher borrowing costs introduce new risks for countries with heavy debt loads. This creates a feedback loop. As yields rise, fear rises, and fear pushes yields even higher. Japan's move was the spark that ignited this loop, revealing how interconnected and vulnerable global bond markets truly are when even one major player adjusts its stance. A decades-old system built on ultra-low Japanese rates began to unravel the moment Japan signaled it was stepping away from its role as the world's quiet supplier of cheap money. For more than 30 years, Japan kept interest rates near zero and sometimes below zero, not only to stimulate its own economy, but to stabilize a nation fighting deflation. What most people don't realize is that this policy didn't stay inside Japan. It spilled across borders and became one of the hidden pillars of global finance. Investors, banks, hedge funds, and major institutions all relied on the predictability of Japan's low-rate environment. They used it to borrow cheaply, invest broadly, and create layers of financial strategies that assumed those low rates would last indefinitely. This setup evolved into a system where Japan effectively subsidized global liquidity. Because money was so cheap to borrow in yen, it encouraged massive outflows of capital into foreign markets. These flows helped keep U.S. Treasury yields low, boosted global stock markets, and created the foundation of the yen carry trade, where borrowing in yen and investing in higher-yielding currencies became a consistent source of profit. The longer Japan held rates near zero, the more global markets adjusted their structures, expectations, and risk models to assume that Japan would never change course. It became a backbone, unspoken, rarely acknowledged, but critical. When Japan finally shifted, even slightly, the shock wasn't just economic, it was structural. Strategies built on decades of stability suddenly faced a new reality. Investors who relied on the carry trade saw profit margins narrow or disappear. Banks that had grown comfortable with predictable cross-border flows had to reassess exposures. Even businesses and governments indirectly benefited from Japan's low-rate environment without realizing it, because global financing costs were partially suppressed by Japanese capital moving abroad. The unwinding didn't happen because Japan made a dramatic move. It happened because any move, after so long, was dramatic by default. The system had been stretched and built on assumptions that were never guaranteed, and once those assumptions broke, the entire structure had to readjust. That readjustment created friction, volatility, and a sense of vulnerability across markets as they confronted a world where Japan was no longer quietly holding everything in place. The currency reversal exposed the fragile reality behind the carry trades that had quietly powered global markets for decades. These trades worked only because the yen stayed weak and Japanese interest rates stayed low. Investors could borrow enormous sums in yen, convert them into dollars or other currencies, and invest in higher-yielding assets around the world. The strategy looked simple, but it created an invisible river of money flowing outward from Japan into global stocks, bonds, commodities, and even real estate. As long as the yen stayed cheap, the trade was safe. But when the yen suddenly strengthened, that entire river reversed direction. Borrowed yen became more expensive to repay, profit margins collapsed, and positions that once looked like guaranteed wins turned into liabilities almost overnight. This wasn't just a financial adjustment, it was a system shock. Carry trades weren't a niche strategy used by a handful of hedge funds. They were deeply embedded in how global markets functioned. Major institutions, pension funds, and banks built portfolios assuming they could always rely on cheap yen liquidity to amplify returns. When the yen reversed, it forced these institutions to unwind positions quickly, often at unfavorable prices. That selling pressure spread across markets, creating volatility that had nothing to do with local fundamentals and everything to do with a global liquidity engine seizing up. The sudden need to repay yen-denominated loans meant investors had to sell foreign assets to raise cash, intensifying downward pressure on markets that otherwise looked stable just days before. The unwinding also revealed a deeper truth. The stability of global markets was far more dependent on Japanese monetary policy than most people realized. When the yen strengthened, it didn't just disrupt a financial strategy, it pulled away a support beam holding up asset prices around the world. This shift exposed how much leverage and risk had been quietly built into the system during years of ultra-low Japanese rates. Once that support weakened, markets had to confront a new reality, one where volatility rises, liquidity thins, and the comfortable assumptions that carried investors for years no longer apply. Investors around the world were forced into a wake-up call because Japan's shift revealed something that had been hiding in plain sight. The stability they believed in was never natural, never permanent, and never guaranteed. It was engineered. Global markets behaved as if conditions of the last 20 years, low rates, cheap borrowing, and abundant liquidity, were the baseline. People built portfolios, business models, retirement plans, and risk assumptions around a world that felt steady and predictable. But once Japan changed direction, that illusion cracked. Investors had to confront the fact that their sense of safety was built on policies that could change at any moment. The belief that global markets were resilient suddenly looked like a story people told themselves to feel secure. This wake-up call also came from the speed of the reaction. Markets didn't shift gradually. They moved sharply, almost violently, reminding investors that global finance is interconnected in ways most don't fully understand. A decision made thousands of miles away instantly affected asset prices in the US and Europe. This isn't just about money moving around. It's about recognizing that a single policy adjustment can expose how much leverage, speculation, and dependency is embedded in the system. Investors realized that diversification didn't protect them from structural shocks, and conventional wisdom about safe assets could be overturned in a single trading session. The moment also forced people to rethink their assumptions about risk. For years, risk models were built on a world where central banks supported markets and volatility was suppressed. Investors thought downturns would always be softened by intervention. Japan's shift challenged that belief by showing that even a major central bank could prioritize internal pressures over global stability. That meant the old rulebook, where cheap money cushioned every fall, might not apply anymore. Perhaps the most important part of the wake-up call was psychological. Investors saw how quickly narratives change. What once felt like a stable era now looks like a temporary phase that ended without warning. That realization creates a shift in mindset. People begin questioning whether other long-standing assumptions might also fail. It's not fear that drives this shift. It's clarity. And once clarity sets in, markets behave differently, investors behave differently, and the entire rhythm of global finance starts to move in a new direction. The shift marked the beginning of a new financial era because it forced the world to recognize that a system built on endlessly predictable monetary behavior was coming to an end. For decades, global markets operated with the quiet assumption that Japan would always keep rates near zero, always keep the yen weak, and always allow capital to flow outward without friction. That consistency created a foundation that investment, strategies, corporate decisions, and even government policies were built upon. When Japan reversed course, it signaled that the rules that shaped the last generation of financial behavior were no longer reliable. Investors suddenly had to face the fact that global capital flows could reorganize, long-standing advantages could disappear, and markets could behave in ways that no longer mirrored the patterns of the past 20 years. This new era is defined by instability that isn't random but structural. Rising Japanese yields mean global money becomes more expensive. A strengthening yen means foreign markets lose a major source of external support. Bond volatility becomes a new constant, not an exception, and every country, from the US to emerging markets, now has to navigate a world where safe assumptions are replaced with competing forces. Investors must adapt to higher borrowing costs, currencies that move more aggressively, and asset prices that no longer float on abundant liquidity. The transition is uncomfortable because it exposes how dependent global markets had become on conditions that were never meant to last forever. What makes this shift an era-defining moment is not just that Japan changed direction, but that the change exposes deeper vulnerabilities in the global system. Countries with high debt burdens now face refinancing risks. Markets built on leverage face new constraints. The safety nets that once kept volatility contained are thinner. Investors have to develop a different mindset, one that prioritizes resilience over convenience, awareness over assumption, and strategy over complacency. This era demands more personal responsibility because the environment will not automatically cushion mistakes the way it once did. Ultimately, the shift marks the beginning of a period where adaptability becomes the most valuable skill. The world won't collapse, but it will reorganize. And those who recognize that early will navigate the changes with clarity instead of fear.